So I'm admitting everyone, okay?
Okay.
Okay, so welcome everyone. Good afternoon, and I would request everyone except for the speakers to just turn their mics in mute so that we don't have disturbance around. Hi Jimmy, hi Rajesh sir, hi Amitabh, hi Sahil. A lot of known faces there. Thank you so much for joining in. Let us just start by introducing our speaker here, and he's already here on time. So, let me introduce all of you to Mr. Vinay Matthews. He's the founder and CEO of finance.com. It's a fintech company, and the idea is very simple that they are one of the pioneers in the P2P lending platform, which is the most recent form of, or the most recent way of lending that is authorized or that is probably permitted by Reserve Bank of India in the Indian financial ecosystem. So we're expecting a participation count, a heavy participation count. So people will keep joining in. I'll keep admitting them. Anshul, I'm making you the co-host. So in case you see someone in the waiting room, just let them in. Okay.
Yeah, sure, sir.
Okay. Thank you. Okay, to go ahead, let me first introduce the speaker for today. That's Mr. Vinay Matthews. So Mr. Vinay started as head. My apologies. He's represented a lot of elite companies like Rediff.com, Bennett. He's there. He's worked with Times Jobs for almost 5 years, and finally 7 years and 3 months it's with Faircent.com. He's the founder of the company and he's the CEO. He's done his MBA from from IMS Indore, and the idea is very simple that he's a guy of internet, and like he always says that it's an outsider who creates a marketplace. So he's not from finance, but he's the one who has built this amazing marketplace for peer-to-peer lending, where generally we see that in an unorganized setup in India, and he's the one who has pioneered in turning the wheel and bringing the unorganized lending sphere into an organized sector. So not taking much of your time, I would hand the reins of this today's session to Mr. Vinay. Over to you, Mr. Vinay, and we would have a lot of Q&A sessions. So let's go ahead and patiently listen to what he has to say. And once he has finished, we all of us are more than welcome to unmute ourselves and put our queries in the chat box or to directly interact with him. Over to you, Vinay.
Thank you so much, Manuel. What a lovely morning. If all of you are from Delhi, I think it's a nice winter, sunny morning. Good morning, or rather good afternoon to everybody. I have a small deck here. I'm going to kind of run that past without wasting much time. So fundamentally, what I'm going to do is I'm going to talk a little bit about what two-sided marketplace is and how that gets built. And then, we'll talk about how peer-to-peer lending sits on that. And from there, we'll tell you what exactly we do, to make sure that the investments that you are making, make sense, should make sense. So we're going to talk about that. And then we will kind of open this up for Q&A, okay? Quickly, we are a two-sided marketplace, which means that we have two very strong sides. One is the demand side and the other supply side. When I say two-sided, it means that we are a classical two-sided, where we have large number of customers on both sides. So we have lenders, thousands and lakhs of them. Similarly, borrowers, we have, lakhs and thousands and lakhs of them. So what we do is that through this platform, we are able to kind of get their interactions going and, get them to do transactions. Okay. So that's what, it's similar to this would be, let's say, any two-sided marketplace, be it Amazon or Flipkart, Uber, Ola, all of these are two-sided marketplace. So the thing is that, there's a lot of engagement which happens, and that's what brings in a lot of stickiness because of the transparency, all of that, right? It helps retaining a lot of clients, large number of them, and they see a value which is, cost effective and which is faster, and that's the reason, this entire growth of within the two-sided marketplace happens. So So we are classically, call ourselves a two-sided marketplace. And how P2P lending looks like as of now. So clearly it is two sides, as I said. So there are a large number of individual lenders coming onto our platform to invest, and on the other side there are a large number of business as well as individual borrowers, salaried individual borrowers who come onto our platform. Okay? So this is a new way of lending, and this fits into an economy which is called sharing economy. Sharing economy has been there around for the last, I think, 10, 12 years now. Okay, so this is nothing but it started with a long back with Yahoo. I know how many of you remember Yahoo had something called Yahoo Groups. That was the genesis of sharing economy. Kind of moved to the second generation when Facebook gave you a wall for yourself. You could share things, you could share your pictures, you could share a lot of things, within that wall. And from there, it moved to the next level, which is the third generation. Currently, the third generation of sharing economy is happening, where people started to transact. So if you have a car, if you have a car, you can attach yourself with Uber and make money out of it. If you have a house, you can attach yourself with Airbnb and make money out of it. And all of this we have seen in Indian version also. There is Ola, there is Oyo, all of this has an Indian version. Similarly, if you have money with you, extra money, you can share that money and make money out of it. So basically, any asset you could trade and kind of make money out of it, or you can lend and make money out of it. So that's the way it works, right? So this sharing economy has become very big, okay? And globally, this has become very big. People are sharing a whole lot of things. They're not just house, or they're sharing their books, they're sharing their music, they're sharing their jewelry, they're sharing office spaces. So a whole lot of sharing is happening. And when we say this, there is a lot of method in the entire thing when the sharing happens. Okay? So for example, in Uber, if the sharing is happening, so Uber is generally not going to put you up if you want to drive. You just generally put you up on their network. So they will do a little bit of curation, and happens on all two-sided marketplace, especially where there is which fits into sharing economy, right? Because we're actually trying to do a transaction which is peer-to-peer. So that's the reason it's important. So globally, I think peer-to-peer lending. So globally, peer-to-peer lending has become very, very big. India's story started 3 years back. It started some 12 years back, 12 maybe a little more than that. 2005 it started, 2005-6, so basically around close to 15 odd years now. Yeah. So it started in UK, quickly moved to US, parts of Europe, Latin America. China became very big in peer-to-peer lending. India's story started, technically 3 years back, but that's when the regulation came. But we've been operating for the last 6-7 years now. Okay. So this is it's a very, very large business right now, 350 billion, growing annually at a 50 to 80% CAGR. It's one of the fastest growing BFSI space. It's exponentially growing across the world. And there are a lot of markets opening up right now, a lot of regulations coming in various markets. All of that is happening as we speak. So every crisis brings in a lot of interest and a lot of throughput in these kind of models. So we've seen that happen in India as well. In the 2008-9 is when they prepared and people started talking about it, and it's kind of got regulated and all that. And suddenly we saw this COVID, and we again saw unprecedented spin-off within this particular segment. So we had huge amount of lenders and huge amount of borrowers coming out of the platform and started to trade. Anyway, so there are a lot of reasons for it. I'm going to cover some of it. Some of it I'll kind of see whether I can cover in Q&A. So growth drivers in India is very clear. We are a country which is internet penetrated, and the digital screens across different formats are exploding in India. We are a country with great technology people. This one works on blockchain pretty beautifully. Also, we are a young population. They need finance, and the young population need alternative and interesting ways of investment. So it makes sense. We are a young population. People want to kind of trade. It's a regulated space. 3 years back it wasn't when we started. Now it is. Now technically you cannot do a peer-to-peer lending site. You could still do a shopping site. You could still do a food delivery, side, but you cannot do a peer-to-peer lending site now, okay, because it's been regulated. If you have to go take RBI's permission. Only then you can start. After they give you the license, they'll give you in principle approval, and then you have to start the platform. And only then you'll get a license after they see you and how you operate. So it's a pretty tight regulated space now. So there are close to 20 players in this space. Yeah, so all the transaction in this entire thing happens digitally, there is nothing offline in this, and that's how the regulation wanted it to be. So there is no trace of paper, there is no trace of money, cash, or anything of that sort. So it's very okay. So what are the benefits? So clearly, I think on the borrowing side, we reach out to large number of unserved and underserved market. By offering them cheaper credit, and we are able to offer them cheaper credit because we are technically, removing the incumbents and middlemen, intermediaries, all of that. Okay, and that's and the operating cost of the platform is very, very low. We have just one office in Gurgaon, and we reach out to 600 locations in the country. We don't have a branch model, so that saves us a lot of cost. Also, because it's coming directly from people, the rates are cheaper than HDFC Bank. So we have one of the cheapest source of capital. So we offer loans as low as 10% on our platform, unsecured personal loans I'm talking about. So the way it works is that we don't make money out of the interest. So interest money most is made by the lender who comes and invests on the platform. So there is no cost of capital to us, anything, nothing, So whatever, if the lender is okay to kind of lend at 7% or 8%, we can offer that at 7-8% on the platform. But till now, we have seen lenders are comfortable, starting from 10% onwards. Anything less than that, they're not very comfortable. Doesn't move much on the platform. So we've kept it at 10% as of now. So completely, unsecured, as I said, zero collateral, very fast processing. It's completely tech play. And it reaches out to micro SMEs as well. It's a very important segment that everybody needs to be aware of. Because if you don't fund these micro SMEs, the growth of the country, employment generation, all of that comes under question. So it's important to kind of finance them, let them grow, make sure that they are giving employment and thereby growing the country. On the lending side, I think it has better returns. On investment. There is a month-on-month income generation also. Then an option of month-on-month income generation also that you can do if you're investing on the platform directly, cherry-picking borrowers yourself. It's supported by great technology and credit experts, risk analysts, to make sure that your risks is taken care of. I'm going to talk about this in detail. Plus, there is returns are quite stable. It's less volatile. Like a stock market, because ultimately these are debt products, So basically, there is a contract. You sign the contract. The person is liable to pay back, right? So it's debt instrument, and that's the reason it is less volatile than a stock market. It's not sensitive to bad news, right? So, and also a lot of people come onto our platform to contribute back for the growth of the country, for growth of individual as a whole. People, all of that. So that's the other part of the benefit that you can come in. So there's a social impact, social angle to it as well. Okay, so Faircent quickly. We are basically an organization. We have done close to 1,500 crores of disbursement. We have processed 2 million individual borrowers on our platform. We have 2 lakh lenders on our platform. They come and lend on our platform to these borrowers. We occupy in the P2P lending space more than 70% of the market. And that's because we moved first within the space. And in the internet business, if you move first, you have a lot of advantage, right? So it's very difficult to kind of garner market share after that. Okay? And you look at any category, after category, there aren't many more than 2 or 3 players in any category. And the market leader occupies a lot of market share. There is nothing left for the third guy, the fourth guy, the fifth guy to kind of come and take market share. So the internet behaves differently, unlike a brick and mortar. You have 25 car manufacturers, all of them making money, right? From Maruti 50%, BMW 2%, all of them making money. But internet doesn't happen like that. So in the job space, if you have Naukri occupying 70% of the market share, there are very few times jobs, and Monster, and a little bit here and there, Shine. That's about it. Similarly, if you have 60% market share by Make My Trip, you have a Yatra and a Ogo, Ibibo, and all picking up little bit, little. But you don't have, a lot of players. If you see any category, be it shopping, Amazon and Flipkart, and be it Ola, Uber, be it Swiggy and Zomato. So you don't have many players, especially in the curated space. The number of players is limited. So RBI giving out 20 licenses will not make sense as we go along. You'll see, if it's a tech play, it'll get converged into models which are, a little bit more skewed to the market leader. Anyway, so we have on the lending side, we have close to 800 lending partners, right from ICICI, Securities, GM Financials, all of these, partners, have come onto our platform, partnered with us, and, their customers are coming onto the platform and investing. So that's one way we kind of aggregate a lot of lenders on our platform. We have disbursed close to, 150 loans in the last 12 months. This is in spite of COVID. On a monthly basis, we do 110 to 120 crores of disbursement. There is close to 75,000 borrowers that we process, 20,000 loans that we disburse in a month. There are 50 odd borrowing partners that we have. Now, these partners are nothing but they bring us captive borrowers, right? For example, companies like Samsung, MobiKwik, Paytm, so these organizations, they would have their set of customers. They will bring in those customers. They would, these customers would be doing transactions with them. They bring us those customers for them to fund. And for them, it is also important if you can finance these customers, it improves the stickiness for those partners. So it's important. The other thing is that we have close to 2.5 lakh transactions happening in a day, which means that one loan is not consumed by one individual directly. For example, if I need ₹1 lakh and you are an investor on the platform, you don't come and give me that ₹1 lakh. Okay, it doesn't work like that. So basically, what happens is that if I need ₹1 lakh, I get maybe 500,000 rupees from you. Okay. Similarly, I'll get this ₹1 lakh going with 50, 100, 200 lenders on the platform. Now, what it does is that your ₹1 lakh goes and plays out and picks up hundreds and 200s of borrowers, right? So that's how it mitigates a little bit of risk for you. So that's how the technology works. So because of small transactions that we have on platform, we do close to 2.5 lakh transactions a day. So ours is a very busy site, if you see. So it's all the loan agreements. There are 2.5 lakh loan agreements which is getting generated. There are transactions which is happening. Money is moving of these 2.5 lakh transactions. From lender to borrower, all of that happens, right? So it's a okay. So quickly, how we mitigate the risk, if you're investing on the platform. So I'm going to cover these three things. So I'm going to talk about assessment, I'll talk about verification, and I'm going to talk about collections, right? So these are three things that people want to know, and by which, they will get an understanding about how we operate, right? Okay, so this is at a 30,000 feet level. I'm going to quickly run past this. There are certain things that we do before the borrower goes live on the platform. And then we do a whole lot of things after the borrower is live on the platform. And then there are system level rules and risk mitigations that we have plugged this in into the system. And there are some institutional level risks. I'm going to cover this one by one. So before the borrower goes live on the platform, the technology does a lot of curation, right? So 80% of the borrower gets weeded out by technology. Now, there are some hard specs there. And technology is able to eliminate those and not let the borrower get into the system. So, example, age would be one of them, income would be one of them. A certain level of income below will not, let the person get into the platform. Then there will be, certain, pin codes or certain areas, we don't operate out of. We don't kind of get customers from there. There is a certain CIBIL score and above you have to have, only then you can get onto the platform. There is so those are some 3-4 specs that we have, only which you can enter the platform, right? So that when you're registering on the platform, this simultaneously checks at the background, right? So if you do not qualify any of this, so it'll throw a thank you message and you kind of get rejected on the platform, right? So the ones who kind of, goes through, so there is a lot of data validation happens to third party. Okay. So when we get data of these, individual customers, we process this data and we figure out, for example, if I have your email ID, your, date of birth and your address, and your, phone number and all of that. All of that is what we, ask customers to, put out. I'm able to pick up, your bureau data, right? So bureau data talks a whole lot of about, how your past performance has been, all of that. So we look at not just, one set of data. We have a variety of data that we, pick and choose, and pick up for individual customer who come onto our platform. So there is social data, behavioral data, psychometric data sometimes. Mobile data is common because a whole lot of data gets picked up through the app. Financial data is through banking, bank statement and all. Bureau data, they pick up, and then we also pick up location data. Now, all of this that we do is for to figure out the ability, stability, and the intention of the individual who we are trying to fund. And I'm going to talk about this a lot, about the validation part in my subsequent slides. But as of now, just try and understand that we look at a lot of data to kind of before we move the customer to the next level, where the risk person looks at, manually checks. There is a rule engine that we have. It goes through that rule engine. He has to kind of clear that rule engine. The rule engine is nothing but set of parameters as per whatever the policy that we have, and it has to go through that. It has weightages, it has ranking, and it throws out the net result. It throws out is that what's the kind of loan that person can get, what is the rate of interest, and what is the tenure that one can look at, right? So all of this the rule engine spells out, or else the rule engine rejects, right? So there is a rejection which happens there as well, and then once the customer gets through the rule engine, there is a e-verification process which happens. Earlier we used to do physical, and also there is a reference check. So we still do physical if the ticket size is big. Then there are some references that we pick up of the customer in that process through the verification process. And post that, we get the NAC mandate set up and the e-mandate set up and all of that. And in large cases, we also go pick up check as well. So all of this we do before even we show the borrower to you, right? Before the borrower is live on the platform, we kind of make sure that all of this is done. Okay. After this, we make the customer or the borrower live in the platform. The borrower data, all the data that is picked up, if you see on the top, we show that with full transparency. And now this is what is a two-sided marketplace feature, right? You're shown data very, very transparently, and that's what brings in a lot of trust. It's not because of deep discount that you go to Amazon and Flipkart. It's because of the transparency that they provide about the product, about detailing of the product. What are the things, whatever they're going to buy, it gives you so much of detail, and who's selling it to you, what is his rating, whether is there any bad rating, all of that it gives you. And after that, when you buy the product, if you don't like the product, you can just give it back, no question asked, right? Similarly with Uber, where the driver is, how far he is, how long is it going to take to reach, what is his mobile number, how many trips he has taken, what is his rating, all of that you get to know. So that's transparency is what builds stickiness, and that is what builds trust, all of that. So similarly, we got to give out data and with full transparency, and you can look at that data, understand, figure out, and the borrowers could be in the range from 10% going up to 36% rate of interest. The higher the rate of interest, the higher risk the borrowers carry, and whatever risk element which is there is also highlighted. Pretty much you'll get to see what's happening with that particular borrower. Every detail of his is shown: personal details, professional details, his banking details, his bureau details, his underwriting report, his bank statement, his last 3 months bank balance, everything. So his all the documents, his his KYC documents, his other documents, if he has submitted any rent document, anything, so all of that is put out very transparently for you to kind of go through before you invest. So it's all data driven. It's not that someone's coming and giving a soft story to kind of get you money out of you. It's not something like that. So we purely as a data driven organization. Once the customer gets funded, after the borrower has seen the profile and starts to fund, once 100% funding happen, the loan agreement gets initiated, right? It's also a technologically, it's a click and wrap agreement. Once that happens, lender is expected to kind of move the money from his escrow account to borrower's escrow account. Now, what is this escrow account? This is nothing but, your money, from your personal account moves to your escrow account, which is there in the master escrow account, which is managed by Faircent. Under this, there will be an escrow account. But this escrow account is a very guarded and protected escrow account because I don't run this escrow account. There is a trustee which runs this account. Okay, we are on the rails of ICICI Bank, so all the instruction that the lender gives, I pass it on to the trustee. Trustee instructs the bank. Only then the money moves to the borrower. So it's a very guarded, ecosystem. This is what has been spelled out in the regulation. And the reason for this is because there are a lot of instances in the past that people have, which has happened where people have operated and they were just shut shop and just ran away, right? So fly by night operators, all of that. So you don't have to worry about that piece in this because all your money is locked here. We cannot touch this money. We cannot withdraw this money. So all of this is guarded pretty well by everyone. So yeah, within this particular account, from one side you put the money, on the other side borrower's NAC is stitched. Okay, all the collection piece is stitched with of the borrower's account on this particular account only. So all the money gets drawn down to this particular account. From there, it kind of moves back to a lender's account. So that's how this entire escrow mechanism works. Okay, system level rules and mitigations. There are 3 golden rules. One is fractionalization, which is nothing but, I talked about your lakh rupees goes across to hundreds and 200s of borrowers, right? So it's not limited to one borrower to borrower. That is one. Banks do this. They have large sums of money. They just don't give it to one person. They kind of distribute to a large number of people, millions of people, right? Second rule is distribution. Distribution is nothing but we operate out of 600 locations. We don't focus or concentrate on one particular location, and it's by design, right? So, for example, our distribution is so good. Just to give you an example, the largest market that we have is Bangalore, and Bangalore has 3% market share in the total borrower distribution that we have. So you can imagine the kind of distribution that we have. So why this is important is because, to me, distribution risk is far greater risk than credit risk or fractionalized risk. Because if your money is concentrated on one particular city, if something happens to that particular city, all your money goes away. Okay? But that's not true with credit risk. If your credit risk is weaker, you may have a couple of them going bad. Same is the case with fractionalization. Okay. If your money is not broken too fine, it's fine. If you're breaking that to 10 people and giving 10,000 rupees each, it's still okay. But distribution is a crazy one. So if you don't distribute the money to a larger number of cities, chances are, and we've seen that 3 or 4 years back, there were Chennai floods. A lot of people lost money. They were focused just on putting money in Chennai. Similarly, Kerala has a couple of floods. In this COVID also, we saw Bombay and Pune kind of having a lot of issues initially on, and a lot of borrowers, slowed down. It's always better to if you had just 2% exposure in Pune, your smaller cities where there's no COVID, they were all paying back, right? So it helps. Distribution kind of helps a lot. Last rule is that we have different kinds of loan products. We just, break this unsecured loans to various kinds with respect to the tenure. So we have daily loans, weekend loans, quarterly loans. Then we have 6 months, going up to 36 months, right? So that's one type of, and shorter loans have a higher risk, longer terms have a lower risk. So it's like that. So then we have on risk. So we have, borrowers from, 10% going up to 36% I talked about. So those are also different kinds of borrowers. Right? Then we have organizations, different organizations coming in, funding us. Giving us borrowers. So you will have a MobiQuick, you'll have a, Eco, Payman, all of these organizations, they come and, borrow money on our platform for their customers, right? And then lastly, we have different types of, loans, right? So there is a salary, there is a business loan, there is a microfinance loans, there is education loan, there is medical loans, so there are different consumer loans, different kinds of loans. So basically what I'm trying to say is that there's a good mix of type, risk, organizations, and tenure, all of that we put it in the product. And why that is important, because different product has a different flavor, different risk element. All of that is different, right? And in your portfolio, you should have a mix of these products. And we have kept it like that by design. No organization has a very large exposure. For example, a MobiKwik would not have a very large exposure on us, or for that matter, 36% would not have a large exposure, or a 10% would have not a large exposure, or a particular 10 or 36 months loan would not have a large exposure, or a one-day loan would not have. So basically, what we are doing is that we're having a mix of borrowers of different tenure, risk, all of that, and give it out to our lenders. So basically, what it means is that invest small amount of money in large number of borrowers to kind of get returns. We also have an auto invest, which basically you can put some rules, or there are some parameters. You can select those parameters. Your money will start moving through the system on its own. You just have to park money, and the money kind of moves out to those borrowers. And auto invest uses cloud's intelligence. It's a self-learning model where the top 1,000 lenders investments is taken, and they've seen how they have invested to kind of maximize the returns, and that intelligence is used to kind of put your money out to borrowers. So it's a self-learning. So if you're the guy who's making more money than the 1,000, you will get in, and the guy who's the last gets out. It can kind of runs by itself. We also give a very detailed dashboard. It's backed by a lot of analytics, a lot of data. This is nothing to kind of, it compares your platform's performance to your performance. This is basically to kind of course correct your investment. For example, if you are invested in Delhi and not invested in Bombay, let's say, or Mumbai, and you look at the data and you see that, Mumbai is, giving you a slightly better returns than Delhi. Okay, so maybe it's time for you to kind of start investing in Mumbai. But if Delhi is giving better returns than Mumbai, and you're not invested in Mumbai, you're good. You're better off. So the platform. So city is just one example that I gave. There are various cuts that you get. Not just city level. You get male, female, married, unmarried, different kinds of loan products people are taking, city wise, so state wise. So there are various mix that you get. Some, I think, 15, 20 cuts that you get, basis which you can course correct your investments. Plus, there's a lot of reports. There is a lot of information. You get to see the collection report, the investment report, the EMI reports, all of various. There's some hundreds of reports that you get for that. So it's a very detailed one, and it gives you a lot of information about how your investment is happening. So it's very, very transparent where your money is going and how it is performing. Even the collection dashboard, and if you see, if the money is going low, delayed, there is disposition which actually tells you, what is the delay, what the borrowers say, how when the money is going to come back. All of that is there. If there is a legal case, if there is a dunning letter sent, if there is a court case hearing, summons served, all of that, it kind of details out that. So, and the last is the institution level risk, which basically means that we cover legally all our lenders. In case of borrowers go bad, more than 90 days, we go after them for full recovery. We try put criminal case against the borrowers for the recovery. So it doesn't matter whether you put 500 rupees, 1,000 rupees, but as an organization we do this. This is again as per regulation. We have to do recovery and legal case on behalf of the lenders. This is on a best effort basis. This is something that is mandated by RBI. Okay, I'm going to talk about assessment now. So basically, the borrowers gets digitally onboarded, and from there is a. So I'm going to deep dive now. Okay, so this is a double click on the data part that I was talking about. This part I was talking about. So I'm going to double click this. So the customers get onboarded on our platform, and there is a sharp segmentation which happens, and this is important because we understand who this borrower is, and in a basis that journey of the customer moves. Okay, we don't kind of weigh everybody on the same platform or on the same level, right? So a good borrower kind of should move on the platform fast, and a riskier borrower should kind of move a little slow. So that's the design, right? So once that happens, segmentation, it moves to the rule engine. Rule engine checks. And from there, it there are a lot of data points today that we look at of a particular customer. I'll show you this snapshot of the rule engine, and from there it moves to risk mitigations. There are a lot of validations that we do of the data. And all of this validation that we do is from third party. We don't rely on what the customer is giving us. So example, customer is giving a bank statement, we do not believe in that, okay, or ID that he gives, or anything for that matter, any document the customer gives, all of that gets validated by a third party, from outside. It's all technology, it's all APIs that we have pulled from various organizations through which we are able to mostly government organizations and all that. So get pretty much validated customer before it moves to the next level, where we do the video verification of the customer from data which we have collected maybe at the initial onboarding stage. But the idea is to verify whether the customer that we are, giving the loan is the same customer that has got onboarded on the platform, is the same customer that has given us the, all this, data points, right? Validations. Once that is done, there is a reference pickup, reference check which happens, and then the approval and the loan disbursement happens. So in the next 15, 20 minutes, I'm going to talk about this. Okay, this is the most important piece. You have to understand this. How an organization is doing what it's doing at the background, for you to not realize that it's such a easy. So it's so when you see an Uber app, or for that matter an Amazon app, it's so easy for you to click. The user experience is very good, right? But at the background, there's a whole lot of work which is happening, right? So for us also, we are two sides. We are practically running two organizations, lending side and the borrowing side, completely different set of customers, a completely different team managing these customers, different technology, all of that is completely different. So basically we're running two organizations, we're boiling two oceans, right? And that gives that, whole lot of that we do is what I'm going to talk about in the next 15, 20 years. So 15, 20 minutes, okay? So I'll start with the segmentation part, then I'll move to rule engine, then I'll talk about risk mitigation, and then I'll talk about video verification. Okay? So this is the segmentation. So what we do is that we do a lot of bureau data checks, okay, to segment the customer. The first thing that we do is that we try and understand how long the customer has been in the bureau, okay? As in, has he been in the bureau for 3 months, 3 years, or 13 years, okay? I'm interested in knowing this because I don't give money to customers who bureau vintage is less, right? I need a little bit of data for me to validate that customer. So that's why I said bureau score is very important. You get a good score. If you're new to credit, you will not get a score, right? So if you get a good score, that's a function of repayment, is a function of some data that you have on your bureau, right? The other thing that we look at is what is the bureau score, right? And bureau score is something we don't look at it just from a static point of view. We look at how the customer has moved in the last, let's say, 6-9 months. Has his score moved up or his score moved down? For example, if I'm looking at a customer and he's having, let's say, 700 score, but is he coming from 850 to 700, or is he moved up from 650 to 700? I'd rather catch a guy who's moving up than somebody who's coming down, because a couple of months down the line, you might see this guy sitting at 650 or 600. So it's always better to see that data, how it is moving in the last 6-7 months before we go ahead and decide to lend that person money. We also interested in know what is this product holding. Does he have a home loan, auto loan, a credit card, two-wheeler loan? What kind of profile this customer is? Does he have a home loan of 2 crores and an auto loan of 20 lakhs, credit card of 5 lakhs? Or does he have a home, a two-wheeler loan of 50,000 rupees, a credit card of 25,000 rupees? It pretty much tells me what kind of person that I'm talking to, right, or interacting with. So a customer which has a home loan, auto loan, larger, a good customer, or a customer who requires a little larger sums of money, that journey of those customers moves a little faster, as I said, in the platform. So it's for me, it's very important to segment those customers right away. Then, and also set priority on the ones which are good, right? So also we want to understand, is there any product purchase behavior that we have seen in the last, few months or years, right? This is nothing but, a lot of customers now, what they're doing is they're sequencing credit a lot, okay? Which means that, today, because of the online, interactions that the customers are going through, you get EMI free loans, you get pay later options and all that practically in every app or every destination that you are going, right? So basically, if you're doing that, availing of those, you're nothing but sequencing a lot of credit to yourself, right? Now, the problem with that, there's nothing wrong in doing that, by the way. But the problem is that we have to understand that if the sequencing is a lot, then there is a problem, because if you're running loans, you could come into a situation where the customer is over leveraged. Okay, so it's important for us to kind of see if he's doing a whole lot of sequencing of credit, we stay away from those set of customers. Because if you give a loan and if he continues that habit and you're given a loan basis, his ability to pay, and suddenly you realize that after a couple of months or 2, 3 months, he does not have the ability to pay, primarily because he's sequencing a whole lot of credit as he goes on. So it's important for me to kind of stay away from those sort of customers, right? Then the credit card behavior. It's also very interesting science. It tells a lot about a particular customer. Is he a revolver? Is he using a multiple credit cards to kind of move money from one credit card company to another? What is his utilization percentage? How heavily dependent he is? How many credit card he has? All of that, gives me a lot of information about, the behavior of the person with respect to the credit card. Okay. We also want to know what his performance of repayment has been in whatever time period that he has been in bureau, and we look at it from different time zones and different time frame across his lifetime of he's been in the bureau. Okay, so we want to understand that whether he has been delaying the payments, and how long he's been delaying, 30 days, 60 days, 90 days, or perpetually he's been delaying, or he's defaulting. All of that we get to know. So we stay away from customers who default and delay perpetually. A little bit of delay here and there is fine, but if he's doing it on a regular basis as a pattern, then we don't take those customers. For example, if the customer has 1,000 payments in the last 13 years to banks and NBFCs or whatever, credit cards and all that, out of the 1,000 he has paid 500 delayed, and 500 he has paid on time. On the other hand, you have a guy who has paid 950 on time and 50 years delayed. I'd rather work with a guy who has paid 950 time, because the 500 guy would, and every second time he's going to delay and he's going to suck a lot of my bandwidth for him to chase to kind of get the money back. Not that he's not interested to give it back. It's just that some people take some time to kind of give it back, right? So the moment they give it back, the credit score jumps back. And then when you're looking at the customer, it looks fine, but you don't know the customer is, derogatory. It has a habit of kind of delaying every time. So it's important to kind of look at this data before we decide to kind of lend. So I don't want to kind of delays the lender's money. All of that happens. There is a issue with the lenders. They get a little bit slow down with respect to the investments. All of that is that. So that's the reason we don't kind of much entertain people who are delaying the payments. Right? Number of inquiries. How many inquiries they have made in the last 1 month, 45 days. It's very important for me to know. A lot of inquiries is bad news. We don't kind of take those customers on our platform because he's stressed for money. Somebody's really putting a lot of pressure on him to kind of get the money out. So he's looking at various organizations where he can lend, get some money out from them. So a lot of inquiries is a no-no. It has a very direct relation to default, right? And that's because the money is not put in use. Whatever use the person is needing that money for, if it is not put in use, chances are you're not going to get money. So one of the things that we try and identify in our process is that, how is the money being, what is the, so at the end of the day, it's unsecured loan. So you can pretty much control about whether if he says something and if he does something. But there is this questioning around what is the money you used for? What are you going to use the money for? Is it for business or salary? If it is salary, what is it? Upfront it says for gambling, obviously he's going to get rejected. Okay, but if he's going to say something that he's going to use his money for something else, so we try and understand and probe those, and ask certain questions around that before we kind of decide to kind of lend that person money or not. So, but if the inquiries are a lot, there is a straight no, because a lot of inquiries means the money is not put in the right use. The customer will kind of take that money and give it to the guy who's chasing him, and he'll decide not to pay you now. Now you have to chase him, then he'll go find somebody else to kind of pick the money again and kind of give it to you. So that cycle continues for him. So we might as well not give money to that set of customer, right? Then we also understand, what is his unsecured and secured mix within his bureau. Does he have only unsecured loans, or does he have unsecured and secured, or he has just secured loans? Because in our knockout rules, if you see right at the bottom, we do not take any customer who has just secured loans and has not done any unsecured loans. Okay, NTC anyways we don't take. So if, for example, the customer has taken only gold loan or property loan, okay, and has not taken any unsecured loan, he does not have a credit card loan, a credit card or any personal loan. So we don't onboard those customers, because someone who has not shown behavior on the bureau with respect to unsecured credit, we do not take that customer. It's very, very different, because secured credit is different Then unsecured, secured credit, where you kind of get 50% of the asset value, you pretty much have to end up paying that to kind of get that. Otherwise, you're under loss, right? But in this case, that's not the case, right? So your behavior has to be seen before I can, extend credit to you. Also, we have in the knockout rules, if there is anybody who's defaulted in his entire lifetime of consuming any of the financial products, we reject those guys. Also, anybody who's missed the payment in the last 30 days, has missed the payment for more than 30 days in the last 12 months and more than 90 days in the last 24 months, they get rejected on a platform. And this is not either or, it is all, all these conditions have to happen for the customer to come onto our platform to kind of avail a loan. Also, if the customer has double PAN card, multiple mobile numbers, a lot of addresses is visible on his, data. We don't onboard those customers as well, because those customers are subject to moving, taking my money and moving to another location, and all of that is happening. So we rather kind of stay away from those sort of customers. So those are the checks that we do before the segmentation happens. When the segmentation happens, after this rules, it kind of moves to the next level, which is the validation through the algorithm-based rule engine, right? So rule engine, as I said, is nothing but a culmination of data points. There are close to 200 parameters. All these parameters would be of these marked data points: identity, traditional, family, work, location, all of this. And it has some weightages. It has some options, multiple options within one data stream, and those would have scores attached to it. And those scores is what all this data point goes and sits and attributes to. For example, let's say if the identity data is true, then you might get, let's say, 5%, and the weightage would be, let's say, 2, right? So you'll get some marks there on the basis of the weightage and the data point that has been given. So similarly, there are lots of data points which comes. There is a traditional data which comes from the bureau. In the bureau, there are a lot of data that we capture. So all of that data kind of goes into the rule engine. The FOIL data, the ability to kind of how the customer has repaid in the past, a number of loans, is there any personal loan? There are lots and lots of data, of the bureau which goes into the rule engine for us to kind of. Then there is a bank statement data which goes into the rule engine. How long, is the bank statement, and we have a model by which we assess the bank statement. There are good expenses, bad expenses, and ugly expenses. All of that comes out pretty well. If you're paying your EMI for your home, your kids' education is a good expense. If you're trying to kind of eat a lot out and buying a lot of stuff, that is kind of a bad expense. You should not be doing a lot of frivolous expenses, so that's considered bad. And if you're gambling and all that, and that's reflecting off your bank statement, then it's an ugly expense. Okay, so you have to have make sure that the ugly expenses are not a lot, otherwise the customer gets rejected. Also, there is work and family data which gets into the rule engine. Location data gets into the rule engine, and this is very interesting. I'm going to talk about location data in my verification process as well. It gives information about where exactly the customer is located right now when as I speak, and collaborate that data with the customer when he is entering into the platform, what the data that he has put. Plus cross validation that with the addresses that he has given and the addresses that is appearing in the bureau and with all the documents that he has given. So a lot of location data piece kind of gets validated a lot through technology there. Then education data, social data, digital data, all the transactions that he's doing, utility bills, some of the partners bring us this data. If you're using any of the apps like MobiKwik or Paytm or any of these apps, so it pretty much tells you what kind of utility bills that you are paying through them. What is the amount of money that you are paying as an electricity bill, as a telephone bill? All of that, pretty much tells me what kind of person you are, right? So how many times you need reminders, how many times check bounces are happening, that you can see through the bank statement. We also, so if you are signing in through Gmail, we kind of pretty much read your emails. We have a partnership with an organization. We explicitly take an approval from the customer that we are reading your Gmail. And we get to know your lifestyle spends, categorization of choices that you have. What are the e-commerce purchases? All of that we get to know. The last drive, Uber drive that you took. All of these guys send emails, right? So you pretty much get to know a whole lot of data about this particular customer. So all this data basically goes into the rule engine. So from identity data, traditional, family, work data, location, these are mandatory data. These are not mandatory data. Some partners bring this in. Some customers opt for it. Some don't. So all of this is not mandatory, but these are mandatory data. Don't go. Once this comes into the rule engine is expected to kind of throw out a decision basis risk and fraud. So that's what it's scoring on. And it is, it has to give the tenure, the risk, the rate of interest, and the amount. So that's what it spells out. Once this happens, it moves to the next level where we are trying to validate, all the documents, all the data that the customer has given through third party. Okay, so we have Aadhaar through UADI that we validate. It's a government agency. Then we have salaried borrowers. If they are doing GST also. In fact, for non-salaried, it's not captured here. So we have employment history of a particular customer coming in from EPF data. So PF data pretty much tells me the customer how long he's been working here, what kind of PF he's contributing, and through which I can impute the income also to some extent, and also how long he's been there, and how long he's worked in various organizations in the past as well. So it gives me the stability part also there. Also, if he's got half the PF, for this particular month, I can also, guess that he's just lost his job. So all of that I get to know from the PF data. And this is something which I can keep going back and, getting this data. Once he gives an approval for this, I can just go back and, keep seeing this data again and again. It also helps in collection. For example, the guy disappears and goes away. I can dig into PF data and where's the new PF coming from, which city is coming from. So I can get that to kind of chase the guy back. Then there is, ENAC, e-mandate. There's APIs that we have for this through NPCI, by which, from the beneficiary bank, instructs the, borrower's bank to kind of release money on a periodic basis. So that's what ENAC is. It's equivalent to check bounce if he's not paying the money, and you can go criminal against this if the mandate is dishonored. Right? This is something that we have picked up, a year back. Employability index. This is a very interesting, API, which tells me what exactly the guy's job is. So there are three types which the churn of a particular employee happens in any organization. One could be the nature of the job, could have a high churn. Any particular, for example, a domestic call center would have a high churn. And then there'll be an industry, call center industry itself would have a high churn compared to a manufacturing industry. And there are some organizations which have a hire and fire policy, right? So this organization, what they do is that they map out all these organization, industry, and job role basis, which they tell me pretty much what is the likelihood of this person's job being there in the next 6 months, 1 year, all of that. Right. So, for example, the guys from manufacturing, chances are that he'll have a longish tenure with respect to movement of if he's in call center, chances are that he might move out in the next 6 months, right? So this is primarily because to tell me, what kind of an employee should be given what kind of, tenure loan, right? So you can't give a manufacturing guy a 6 months loan and, call center guy a 3-year loan, right? It doesn't work. That has to be the opposite. So it gives me a lot of information about the organization, about the nature of, job and all the basis which I can make a decision. What's the tenure that I should give to an employee? Because chances are that, you give a call center 3-year loan, you 6 months later, if you stop paying, you come back and inquire about that guy in that particular call center, the guy would have gone by now. So I kind of pick and choose the tenure basis, the the kind of employability index that person is sitting on, right? Then location data. There's another interesting API. We want to understand exactly where you're coming from. Okay, so prosperity index is what this organization tags. So PIN code is history, right? So, for example, and why this is history? Because there's one street on left-hand side of the street, there'll be high-rise building. On the right-hand side of the street, there'll be slums, right? So now with the advent of phones, smartphones, people sitting in the slum can apply for a loan, right? And you not get you think that the PIN code is great, let's go and lend. Because earlier those PIN codes would have laptops or desktops, no smartphones coming in from that area. So people thought they are good areas, right? So, but things have changed because of smartphone. Everybody has a smartphone. So this company, what it does is that it identifies apartment level, street level, prosperity index. So it will exactly tell you this side of street is, high-rise building and has a average income of this much of car ownership, and this much of, this thing. And this side is slums, average ownership, average amount of money that they're making is some, 10,000 rupees of 8,000 rupees, all of that it gives you. So pretty interesting API this is. So they're a layer on top of Google Maps, and basically this, they are able to pick up geotag of various locations and pretty much tells you the prosperity index of a particular area or a pin code, or a street or an apartment. SMS data we've been doing for quite some time. We look at all the SMS which gets triggered on the platform, on your app. Through the app, we are able to kind of get all the money that any money moving out of a bank account or a credit card or whatever, any financial transaction that you do, there is an SMS trigger which RBI has mandated, right? So we are able to get to understand pretty much what's your expenses, what's your income, all of that through SMS. And you can actually calculate a bank statement. We also get to know what kind of expenses you're doing with that, right? So if you're doing expenses on Paytm or on gambling side, all of that we get to know. So the SMS, there is a reverse. Device information is also an interesting thing which we get to know from what is the device he's using, what is the operating system that he's using on his device, right? We get to know that. So is a 7,000 phone or a 70,000 phone, right? It pretty much tells me what kind of customer I'm catering to. But more than that, I'm more interested to know the vintage of the mobile, how long he's been using the mobile. Is it 3 months, 2 months, or it's been 3 years, 2 years. So I'd rather lend a guy who has 3 years of vintage and having a 7,000 mobile than somebody else be skeptical about a guy who has 70,000 rupees mobile and his vintage of mobile number is only 2 months, right? So maybe you just pick the mobile number for. So I need to kind of look at other more data point to kind of really see whether I want to lend this guy or not. The other API that we have is the Card B API, which is nothing but banking. Here I talked about it. It pretty much tells me if you have done any fraud with the statement, it picks up that and alerts us. Because they have mapped out with a lot of banks in the country, and they keep changing the format. The banks keep changing the format, and if there is any tampering that we do, old PDFs or old bank statement that you do any tampering with, and it moves through the system because of the format being changed, you get caught. Okay. This format will have a very minor change, logo being shifted here or some background image changing here and there. So software is able to pick that. And if it is different than what it was 3 months back, then it gets rejected. Okay, you'll be surprised when some 3-4% people really try and finger with their bank statement before it kind of giving it to us. So it gets rejected on the platform. It also CardV also understands and figures out the behavior. As I said, salary bounces, credit bounces, all of that, salary credits, all of that, it kind of maps out pretty well and tells you. It gives you a very beautiful, statement analysis. In fact, bank statement analysis, and this we put it out for our lenders to kind of consume. So expenses, what kind of expenses, all of that. We also have, a two bureau approach. We don't rely on one bureau to make a decision. We make two bureau. On top of the funnel, we have one bureau that we pick up, and as the customer moves forward, we get to kind of see another bureau. And now this is important because what happens is that when you do bureau, single bureau, the chances that there's a lag in bureau reporting. Now, just to make sure that the bureau reporting lag is avoided, it's better to kind of do two bureaus. So you would have, as a bank, you would have reported to CIBIL, you would not reported to CRIF. And if you're looking at CRIF and the customer looks very pretty there, and you go ahead and give them a loan. But when you see CRIF and then you go back and see CIBIL and realize the customer is defaulted this month. Okay, so it's always better to kind of have two bureau approach. So at least the lag part is taken care of. We in fact use 3 bureaus, not 2. Closely, also monitor the customer's behavior post we have given the loan, right? It's not limited to kind of that we have given the money and we just forget about it. What is his performance post that? Are there more inquiries? Are there no new trade lines which are coming up? Is the score movement going up, down? Basis this, we kind of upsell the customer or we give input to the collection team. Okay, so that's a continuous process. So all of this is through, third-party APIs, analytics, all of that happens on our platform. Okay, on the verification side, quickly, what we do is that this is as per RBI direction, the way, verifications happen, video verifications happen. So one is that we geotag the customer's lat long information and ask him to send us a real-time selfie as the transaction is going, right, with the customer. This is a conversation which typically gets happens on a WhatsApp video call. Then that selfie that the person clicks and sends, it's matched with the Aadhaar data that he has given. Aadhaar is mandatory data that he has to get in with. Aadhaar data that he has given. There is a image in that data. That image and the selfie is matched through a face matching technology for the ID proof, right? Now the thing is that if the face matching is less than 60%, the customer gets rejected. If it is more than 90% also, it gets alerted, right? We can't have a Aadhaar picture and your selfie matching up to 90%, right? So it's kind of an alert for us. We all know how our Aadhaar picture looks like with some 2G camera, 2 megapixel camera, sorry. And the guy didn't care whether you're looking at the camera or not, he just clicked, right? So unlike a selfie, which with the latest camera, which is 12 megapixel and all, so it can't be 90% at all, right? So we get an alert. In fact, 85% onwards, we get an alert. Why is that matching so much? Once this is through, it goes through a video interview. The verifier, asks few questions, and all of this is recorded. The software that through which we record this conversation, all this information. The customer is also expected to show his PAN card, Aadhaar card, and all that real time through the camera. Then he is asked to kind of move around his residence. There's a video tour where pictures are taken. He is supposed to move inside, outside of the house, within the drawing room, bedroom, kitchen. Kitchen talks a lot. If it is a loaded kitchen, that means the guy is stable. If it is just a little bit of utensils here and there, some cylinder there, chances are that he might leave soon. He's not, or just gotten there, right? So I don't really know. So kitchen actually talks a lot. We also ask the customer to kind of location, to kind of map the location of his through the WhatsApp. WhatsApp has this feature. We educate the customer to kind of get that feedback back to us where exactly he is. He has to drop that pin. Once that happens, then we are okay with this. Then it kind of moves to the last leg, which is the e-mandate process. The customer is given a SMS, and through that he can click and have two options of net banking and debit card. He has to put in this details, and the successful page happens, and there is an ENAC setup which happens, the process happens. This helps us collect money from his bank account on a monthly basis. And lastly, before we disperse, there is a penny drop which happens. We drop 2 rupees to figure out, get to know the bank account number. On reverse API, we get bank account number, the name of the that particular account, and who owns it and all that. The address and everything, and we collaborate with this data with the guy who started the journey. Right, the data is the same, then the money moves. If the data is not the same, then the money stalls. For example, a lot of people used to earlier give their wife's data and put their bank account. So all of that is not possible through our platform. Okay, so this is how video verification works. Okay, collection. We have a dedicated resource. Depending upon the DPD, okay, so 0 to 30, there'll be a set of people calling. 30 to 60, there'll be a different set of people calling, and so on and so forth. 90 plus will be a different set of people. So 0 to 30 will be all girls, typically talking very nicely to kind of pay up and all that. 90 plus will be all boys mostly. They'll be very rude when they talk. They'll not be nice at all. So depending upon 90 plus, there could be people visiting your residence as well, right? So the borrower's residence. So all of that happens. We have advocates, 3 of them for legal and case filing. We have a new arbitrage clause also, apart from the criminal case that we do, section 138. The arbitrage clause, which is basically recently with the government has made it a little more attractive for quick, this thing. It's a legal case. Sorry, it's a civil case, but with a quick resolution. Okay. So it helps expedite the entire process, and that is something which is very, very required in this case, because it's a clear-cut case of in this arbitrage clause you basically attach the customer's assets and his bank state, he attaches his bank account, his properties and all that, right? So, but most of the cases that we do is criminal case. It's quick, and customer responds also pretty quickly. So loan recall notices, we have done 80 days. It was 90 days earlier, and this got dropped down after COVID to 80 days. So anybody is not paying 80 days, we have this is written in the agreement. We have a right to kind of ask for the entire money, and rule equality notice for the entire money is put. And if not given, then there is a case that we pursue for the entire amount. So that's the condition that we put in the agreement. Um, we present NAC check, all of that I talked about. We also do repeat KYC of customers who delay. And that's important because as soon as they delay, it's important for you to kind of go and do the KYC again, because once it is 90 days plus, the customer will not talk because the conversations become very bitter and very rude and all that. Sometimes they don't even pick up the phone. So it's important for us to kind of get the KYC done immediately as the first day delay it happens, so that you can go back to the customer's residence and figure out where he is going. We also do a lot of analytics on the collection side, try to understand the likelihood of a particular customer going bad. How do we get to know this? There are a lot of early warning systems that we have plugged in with the bureau, which gives me a pretty much alert, and I can take proactive actions on particular borrower. For example, which I talked about, the score going down. Okay, it could be a function of he's not paying money to certain NBFCs that he has taken. Now, if he's not paying, I need to kind of watch out that as well. How is his payment behavior with respect to not just me, but also to other other NBFCs? Because if he's going to stop paying others, chances are that he might also stop paying me in a couple of months, right? Also, are there any new loans that he has taken? Are there any credit card spends that is going up or considerably coming down? For example, if the credit card spend has come down, so with 20,000 rupees credit card spend, and if this month has come down to 2,000 rupees, the chances are that he's lost his job. Okay, people conserve money, and behavior changes as soon as you lose your job. So all of that you get to know through bureau's early warning systems that we have. Skip tracing is nothing but people used to kind of use Naukri earlier for skip tracing. Now there are a lot of data streams which has come through which you can do skip tracing of a particular customer if he moves out from one location to another location. So there are a lot of APIs which have opened up now. We also try and track about customers, any new address, new mobile number, which gets reported on the bureau. If there is, then it kind of goes to the correction team to update the latest address and mobile number, which we kind of track. Or in case if the customer is not talking to us, then this helps. A new number and the address helps to kind of go understand the customer and talk to the customer if he's changed his mobile number. So we kind of periodically look at that on a regular basis. Okay. So this is a product that we've launched recently, which is called Systematic Income. So my kind of the validation part is over, the verification, all of that is I'm done with. So this is a product that we have, offered right now for kind of started this 3-4 months back. Now, one of the reasons we started this is that this is an analytical based program, because the presentation was mostly I was talking about was data and all that. It's a data driven program. And it has seen a lot of attraction in the last 3 months that we have launched this. It's a huge amount of traction which we've got in this. So basically, the objective is to kind of give lenders a non-volatile, stable returns, and it's completely analytical, as I said. It reduces the lender's time, to pick up borrowers and all. Not that you don't have that option. You do have that option. You have all the this thing to go and pick up borrowers if you want. But in this program, in this particular program, you don't have to do that, right? So we kind of through technology, we're able to kind of pick up those borrowers for you and invest on your behalf. Solve the problem of borrowers also by reducing the TAT for them. So borrowers pretty much gets funded within seconds, right? So in this program. Plus, we will give you full transparency that we talked about how the performance is and all. So this product gives you a 12% return. There is a lock-in of 12 months. There's an option of 6 months as well. And the principal and the interest comes back to you at the end of the tenure. Okay. Just ignore the last part of it. This is for partners, this thing. So how does it work? So basically, the way risk works is that if you're in the lowest risk, you can invest in 100 borrowers and make money. But if you're moving up the risk, if you're in a medium risk, you need 1,000 borrowers to kind of make money. But if you're in a high risk, you need 10,000 borrowers to kind of, So now your money will not go fetch 10,000 borrowers. One, either you could have an appetite of not spending that kind of money in peer-to-peer lending. Two, the limitation itself of the regulation of 50 lakh rupees, will not let you that 10,000, borrowers. So that's where, pooling helps. So we will pool all the lenders' money and pick up, tens and thousands of borrowers, right? So that way we have a very good mix of borrowers cutting across various risk levels. which will give you whatever that we make out of it, which net return that will get is 12%. We're able to kind of trade on a little better loans as well. Able to kind of get lenders, a maximum of 12% return. This is that. So you authorize that to lend the Fairsense analytical team to kind of run that portfolio for you. Your money gets invested for 12 months. Whatever money that comes back as EMI goes back again. So this is 12% flat return, right? So it goes back again, it comes back, goes back. And so that continuity we will do. Otherwise, typically what happens is that when the money comes back, lenders takes anywhere between 3 hours to 3 days for redeploying that money to new sort of borrowers. So, one could be laziness, the other could be, you couldn't find the borrowers that you're looking for. So all of that is there. Just 1 second. Also, lenders get complete visibility of their portfolio in terms of the performance and the outlook, all of that. Okay. So basically, we build your portfolio. There is a quarterly performance, monthly performance that we put out. Also, there is a recalibrating of the portfolio, which is going to happen on a regular basis. So the loans doing good will kind of enhanced. Loans which aren't doing good, or any category, organization, risk segment, anything. If it is not type of loan not doing good, we'll kind of rationalize that. Right? Yeah. So this is nothing but just a simple calculation of how it works. So you invest 10 lakh rupees for 6 months, you get 11%. Here you get 12%. These are annualized yields. So the platform makes, let's say, 9.3%. There is lender processing fee. There's a nil, and then there is a, let's say, default and the loan collection fees. All of that fee that we adjust with that, which is the Y part, and there is a net return of 5.5%, which gets back to the lender. So if you make 6% out of it, you still get 5.5. If you make 7% out of it, we'll retain 1.5 and you'll get 5.5. Your 5.5 or 12% is protected through this this thing. That's how we are running this. This is nothing but current allocation of portfolio. This changed a little bit, but yeah. So majority of them are between 10 to 12%. This is a 1 day snapshot. So there are various partners which gets us the borrower. These are those partners who get us the borrowers. So those names are here. So basically, you get a mix of borrowers to kind of so all of that money goes to, and this has been the allocation. So how will we ensure the returns? One, the portfolio itself is very, very conservative approach that we are looking at least for the first 1 year. It's a well diversified, good big mix of borrower approach. We're going to not trade in very high risks. We'll be closely monitoring the account from various data sources. Even the analytical led strategy will be there for collection. And there will be a time to, I've talked about it, time to money recalibration of the portfolio. Also, the team will, if there is any customer that we invest in, which is of medium risk or a little higher risk, that money will go back to the lesser riskier risk. So we'll not be greedy, kind of picking up more and more high risk. The idea is to kind of make sure that it works for our lenders, at least. Next year, you will have a variation on this. You will have interest coming to you on a monthly basis. In fact, you can do that right now. Also, you can have a process by which you invest every month. And after 6 months or the 7th month onwards, you can start withdrawing your interest. And the principal of the 7th month, the principal of the 7th month, the first month that you put will again get redeployed for the next 6 months or 12 months or whatever. So you can do that and get monthly return. Yeah, I think that's it. I'm done. So I know was I able to kind of explain this, but the idea was to kind of tell you how this works. What is the new thing that we have right now? It's also for maybe a lot of you, it's new. It's just that the way we do it is different. Lending has been one of the oldest investments in the world, and rather oldest profession also in the world. It's been there in India, it's been there for many, many years. People do lend, borrow amongst each other. That's the reason there are so many chit funds, kitties. People just lend and borrow amongst each other. So in our 30 years of stock market and all of that, other investments that you see, people still ask, whether this investment will make money or not. Okay, in our 6 years of our journey, nobody asked that question whether you're going to make money or not. Everybody knows lending, makes money. ब्याज में पैसा बनता है, सबको पता है. The question that they ask is, whether the borrowers that you're onboarding are the guys going to pay me back or not. So it's more about your credit due diligence, your the way you're looking at the borrower, you're giving it to the right sort of people or not, right? So that is what is in question, not about whether you're going to make money or not. You will make money if the guy is going to give you back. So happy to take questions if you have any. Yeah.
Okay. Thank you so much, Vinay. I think it was a roller coaster for most of us who do not know lending well. Thank you so much. I guess it's a new perspective. Karan has a question in the chat box. Karan, would you be comfortable unmuting yourself and asking it directly to Vinay? Would that be possible?
Sure.
Yeah.
Hi, Vinay.
Hi.
I'd like to ask, how many bad loans have you encountered so far, as in the percentage of the total loans?
So the way it works is that we have different risk segments, right? Right from the lowest risk of 10, 12% going up to 36%. And at the lowest risk, there is no default. Okay? At the middle layer, there could be 2 to 3% default. At the high risk, there will be some 7 to 8% default. At the highest level, there will be some 10 to 15% default. Okay? But the way it works is that even at the highest level, the way it works is that if you're investing in a large number of borrowers, right? So that's the only rule that we need to kind of take care of. If you're investing in a large number of borrowers, in small number large, you'll still make money. Because if you're around 30% average, if you're lending at that level, and even if you lose out 10%, 12% out of it, you'll still make some 20%, 20% money, right? So the important thing to realize is that the prediction that we do about a particular borrower, and we show all this data online also on our system. So you can pretty much see which range, which risk is giving what return, right? So basis that you can invest. So, but the only thing is that the higher the risk, the more deployment of money has to happen. You can't have play on the higher risk and deploy a small amount of money. You're better off, being in the lowest risk. Okay? So you can't have, you want to make 36% also and you deploy a small amount of money. So that's lottery. Okay, it's not going to happen. So chances are you might or you might not. But if you want to make 12%, you can sit right at the bottom where there are organizations backing us up with their protection of collection guarantees, their protection of some deposits that they've given to us. All of that is there, right? So it's a structured products right at the bottom. But yeah, so I know that I was able to answer your question. But our business is not about default. Okay, it's not about. It's about predicting the risk. Okay, I can still run this business at 20% default, provided if I'm able to price the loan at 60% and give lenders 5, 10 to 15% return. Okay? It's about that. And also my lenders. So why is default a very important, significant thing for other lending companies? It's important because your cost of capital determines, if you have bad loans, your cost of capital goes up. Okay, and the moment the cost of capital goes up, your lending rate goes up, right? And the moment the lending rate goes up, chances are that you'll be trading in some high risk loans, right? And because people who are good would not want, a high rate loans, right? So the moment you do that, your kind of book starts to kind of go bad, right? And that has a direct impact on your stock price. If your profitability goes down, all of that happens. It's all related. So that is the reason bad loans is looked at very, very, differently within a particular bank or an NBFC. But for us, we are risk-based pricing model. Okay. So, for example, if I get to know there is a set of people who are at a high risk, okay, and I have to create a model by which I have to kind of lend these people. The model needs to be created like that to kind of, for example, I don't know whether you guys have heard of something called payday loans, right? It's not, not much organized in India, but in the US and all, it's very, very popular, right? Payday loans are very popular. And there are large organizations, doing payday loans, and not one of them, many of them. They deal in very, very high risk customers, but they still make money. They charge some 300, 400% rate of interest. Last week, they kind of give out loan for, 5 days, 7 days, 10 days, depending upon the customer wants. and there is a model around it, and they've been running for hundreds of years in the US, right? So it's about how you price the borrowers. So if your system is able to kind of risk price the borrowers, right, and that's what all of us are talking about. So the rule engine gives me exactly, where you're sitting in this risk segment, right? What I do also is that I go back and understand why this customer has gone bad, and if he's gone bad, should he be taken up in the risk or should he be taken down if he's not gone bad? So that system is always on the learn, right? So and that's how we kind of categorize the customers. Now, answering whether we will be able to kind of lend borrower at 60%, the answer is yes. But have we created a model there as yet? Answer is no, because predictability goes, quite, or the volatility goes quite haywire as you grow in terms of the risk, right? Also is there. So you have to kind of be a little careful about that. So we have kind of currently at 36%. We do not, and 36% also very few customers come. Most of them are under 30%, 25%. So that's how we range. I know whether I was able to answer your question, but so we don't have a book.
So Karan, what Vinay wants to say is the higher risk you're willing to take in terms of the fixed returns, the higher the defaults probably in that band.
Yes.
But there are no fixed number of defaults that are there because they keep varying based on what provisions probably they take under.
No. So I'm saying the highest level, the default will be in the range of 10 to 12%, maybe sometimes 15% also. But if you have the one who picked up the 15%, all 15%, all the principal will go away.
Yeah.
But on the other side, 85% people who are paying on time, if you pick up those guys, you'll make unreasonable amount of money, right?
Yeah.
But it doesn't work like that.
Great. So what he's basically trying to say is have a portfolio of people who are paying you 12%, who are paying you 13%, 15%, 18%, or 20%, but have some money sprinkled all around the platter so that the default goes down and the return on investment goes higher.
Yeah, that's what the technology does.
That's what the technology
does. The new product they're talking about, that's what it exactly does. Yeah.
Great. Karan, is there a follow-up question or that satisfies?
I have another question. You answered
before we go to that, if it's not a follow-up question, we have another question in the chat box. It's that you mentioned funds are collected in an escrow account. How long do they stay there on an average before it's sent to the borrower? And are these parked in an overnight fund or something like that? It's from RT. I don't know who that is.
So if you're cherry picking the borrowers, okay, then it may take a while for the money to move. For example, if you come onto the platform, park your money, and from there you're picking up a borrower, right? So the money, once the borrower gets funded, 100%, your money kind of moves to the borrower, right? So that might take, sometimes it may take, 15, 20 minutes. Sometimes it may take even, a couple of days, depending upon borrower and the volume of money that he needs. But sometimes good borrowers immediately get funded. Auto invest, if you set up, you kind of get funded a lot. So it kind of gets really moving fast. So it actually depends upon, I told you, it can vary between 3 hours to 3 days, depending upon the lender. So sometimes lenders forget about, the money has come back, you have to go back and reinvest. But in this program that we talked about, an analytical-led program, the money does not stay. So the moment your money hits your escrow account, from that day onwards, your return on investment starts to kind of be counted, right? And it immediately kind of moves out to the borrowers. That is.
So Karan, over to your next question.
Yeah. So all this data is a lot to analyze for a common person. Do you give any scores or ratings to the borrower for the lender?
The rate of interest is nothing but rating, right? The data is, actually telling us. See, one is that what we show as data is something different than what analysis of the data is happening, right? So the analysis is what the rate of interest is all about, the tenure is all about, and the amount is all about. So the output of all that data is this: the amount, the rate of interest, and the tenure. Okay. Plus, we give you data with respect to who this customer is, how this bank statement looks like, what are his, banking, what are the banking saying, what is his bureau details, what are the, how many loans he's taken in the past, how many is returned, how many is bounced, all of that you get to see. I know that I was able to answer your question, but.
Yeah, I guess that helps. Karan, I hope that helps, right?
Yes, thank you.
Okay, great. Vinay, we have one more question here. It's from Mr. Rajesh Sharma. He's a corporate lawyer. He's asking of who does the due diligence. So if I'm not wrong, correct me if I am. I think we have two levels of due diligence. One is we do it internally. Also, we outsource to a third party the due diligence part. Or I guess
the system does the due diligence. We do the due diligence. And there are a lot of APIs which validates the customer. Okay, so one customer, when it moves through a platform, there are some 120, 130 APIs that gets pulled for his validations. Government API, Aadhaar. I talked about all of that. I know maybe you logged in late. So the whole lot of due diligence is happening. I pretty much get to know who this guy is. With a lot of data streams that we have, we pull and understand, figure out the customer. His professional details, his personal details, his family details, all of
that. Is it one-to-one and physical meeting is also allowed with the borrower?
No physical meeting.
And one more thing is that in the systematic system, which you have shown, that the flat rate of interest is 12%, but you have shown in the 17 point something. What is this 17 point?
That is the platform is returning that returns, and plus there are the costs. Platform will have some cost. There is a collection cost. There is a customer onboarding cost. There is a legal. All of that cost is there. So that is minus with that cost, and then whatever we will return lenders 12%. So that's the promise that we are trying to communicate to our lenders. So our job is to make sure that we make only when we make lenders. So I will not make money if the return is 11.5. Even 12, exact 12 if I get, I don't make money, right? I make money only if if it is 12.5, I make 0.5%. Anything which is beyond that is what I make. I don't make money. So I have to work hard to kind of make money and take care of the cost. And also, by the way, risk is a funny thing. So it's not that at least in this investment, it's not that just because you're trading in high risk, you will make more money. No, you will not make more. Let me just put that right up front, right? We are trading on that risk. If you have a large corpus, then it makes sense. If you have some hundreds and thousands of crores, then it makes sense. Then you can make money. Otherwise, you will not make money. Okay. So one advantage is that you'll be able to trade a little bit of the riskier loans because we are pooling the money and investing in. But if you're an investor, if you have a 50 lakh crore rupees to spend to kind of invest, you can get very incremental return on investment as you move up the risk range. Okay, so at 12% you may get 12%. At 15% or 18% you may get maybe 13-14%. But at 36% you will not get like 36%. You will not get even 25%. You might get maybe 17-18%, right? So the grade at which it moves, the risk, your return on investment will not move at the same pace. It'll never. Otherwise, all of them would invest in 36%, right? It doesn't work like that. So
probably because the defaults are higher when we do more return. Great.
Also, in case of legal case, who will bear the cost of the legal advocate?
We bear the cost.
And in case of the systematic option, suppose I make the investment of 5 lakh rupees, that 5 lakh rupees is the one-time investment.
Correct.
And after making the 5 lakh rupees, suppose I invested 5 lakh rupees 1st of January 2021, and then I will get the return on a monthly basis 12%?
No. Currently, this product is that you will get the return after 12 months or 6 months, whichever options that you choose from. So either you get after 6 months or you get after 12 months. One of the two options.
So it means on 31st December 2021, I will get the 5,60,000 rupees.
That's right.
Okay.
Correct.
Okay.
A lot of people
and one more thing is that is 60,000 rupees is subject to TDS or it is a non-deduction of income tax?
No, we don't do any TDS. You have to declare that as an income. So
no, that's okay. But the TDS will not be applicable.
No, we will not. It is peer-to-peer, right? So I'm not giving you the interest. It's a peer which is giving you the interest. So in peer-to-peer, there's no TDS.
But in case of the systematic, it means that I will not identify my borrower.
You will not.
The system will identify.
But it will still go, your money will go to the borrowers only.
And in this case, the minimum investment is the 5 lakh rupees.
Yeah, that's what we are starting off with.
Okay.
Yeah. Okay. Vinay, one more quick question. It might be a little tricky here. Since you mentioned that you don't take anything from the interest, then what is the main source of revenue for FairSend? So what is in it for you?
In the normal setup, I make a couple of percentage from the lenders and anywhere between 2 to 4% or sometimes even 5% from the borrowers. Okay. So the way it works is that, once the money is pooled in by the lender, before I disburse this money to the borrower, I take my money out. Okay. So if it is 2%, I take my 2,000 rupees out. If it's a lakh of rupees going, I may take my 2,000 rupees out. Similarly, when the money comes back, before money moves to the lender, I take my 1% or 2% out, okay, on the lending side. That's how it works. But in this product, in systematic investment product, there isn't a lending fee. So I only take money from the borrowing side.
Okay.
So the performance of the loans is what I will end up making money. If the loans aren't performing, I will not make money. If the loans are performing, then I'll make money. So I have to be performance.
Your success risk is associated to the lender's risk, basically.
That's it. It's not that. My success risk is, associated with the performance. I have to make it work for them. So if I have to make work to make money, the lenders also make money.
Great.
So borrower will make the repayment of the loan on installment basis, interest plus principal. No?
Yes.
It's a term loan.
Yes. A lot of it is term loan. A whole lot of it is term loan. There are a lot of daily loans also. People take money on a daily basis and give money back on a daily basis. There are loans which are, 1 month loan. People take it for a month or 3 months, and give it back. And there are some loans which people, take and they just give interest, and end of the month they give, principal and the interest. So there's different kinds of loans that we have on our platform.
Yeah. Hi, Vinay, Raghav this side. I asked the question on interest part right now.
Yeah.
Could you explain that? I didn't actually get it. When you were explaining in the slides, you mentioned that the lenders and borrowers, they decide the interest rate themselves, right?
No. I never said that.
All right.
Borrowers don't decide the interest rates.
Mm-hmm. The system decides the interest rate depending on what is the risk of the borrower.
Okay.
Yeah. People can't decide. In any good sunny day, lenders, all of them would want 36% and borrowers all would want 12% or 10%.
Right. So you were mentioning in general, it comes out to be better than the interest rate that's being offered by banks and traditional.
That's right.
Yes.
All right. Okay. Thank you.
So I'll tell you why this happens. Okay. Because the cost of capital is cheapest here because it's directly coming from public, right? So otherwise, public, gives it to the bank. The bank gives them some, 6% or whatever, and the bank would lend to, let's say, an NBFC, and from that NBFC it goes to the borrower. So it is changed 2-3 hands, before it ends up being with the borrower. So everybody is putting their, charges on top of it for it to kind of work for them, right? So that's the reason the cost goes up. But for us, it directly moving from, customer to customer. But what happens is that you have to understand. Just because banks aren't lending to these people doesn't mean, they don't want to lend. They want to lend. It's just that their pricing models or their structures don't allow them to lend. Okay, they'll be happy to lend, but is that either the structures or the cost structures don't allow them to lend small amount of money, or the entire structure in which they are operating or NBFCs are operating, that do not allow, because if they are bound by some contract where they cannot lend more than, let's say, 24%, they cannot do that, right? So because banks are saying, assuring they want 15% back or 12% back, depending on if they have lent money. So it becomes very, it constrains the lending, opportunity for that particular NBFC, right? But that's not the case with us, okay? Riskier customers needs to be priced, riskier and higher, and that's how you can recover money from them, right? So a bunch of riskier customers, 5-10% of the people have gone bad. At least the rest, 95-90% of them have to kick in, to kind of compensate for the guys who have gone bad to kind of make money for you. That's how lending works, right? And if people are thinking that banks don't do it, they do it. They do it in a different way. They do it through a credit card. And just try and roll the credit card for a month. You realize how much rate of interest they charge. They charge close to 50%. Okay, so don't think that banks are not doing it. They're doing it. They are more expensive than me. At every level, they are more expensive than me. So you give me a bank's customer, HDFC customer, I can drop rates by 2%. I can assure you. And people are coming to our platform because they see a lot of value in it. We get a lot of small businesses on our platform, lots of that. Okay, and one of the reasons is that the small businesses are being are taken for a ride with respect to rate of interest. People charge flat rate of interest. They charge a lot of money from them, and they can't get money from anywhere else. Banks are not interested in lending to small businesses. Just go down to the nearby shop and ask how many banks have come to them today. Nobody. And so is the case with people working in smaller organizations. Okay, no banks go. For example, my organization, no bank has come to my organization to kind of for a credit card or for a loan. We're not heard of. We're a small company. We're not in their 500 top 500,000 list. But some of the best brains and minds sit in the office. Great people work for Faircent. So it's not about the way they are operating is a little different. But they don't look at it from the first look at from an organizing point of view, then they look at customer point of view. But I can assure you, all the people working in my organization can get a job in Google and Facebook and any of these organizations. They're passionate for working for a fintech. That's the reason they're there. The great minds. Okay, it's just that the way it is constructed, it's a little stifled out. Okay, and that's the reason this will eventually happen, and it's happened across the board. Banks are comfortable doing unsecured, secured loans. So their entire book and portfolio, all of their business has been built around that. And they started some 30 years back, the unsecured piece. In fact, lending itself has started, some 30, 35 years back. So before that, it was not there. I know you know this, right? My dad worked for 30 years. He never took a loan to kind of build his house. He had to borrow it from his friends and families. All our dads did that, right? So during those days, there were no loans available. So now it is there. Banks have come along, and NBFCs is doing a fantastic job. So because of that, the construct of the model, changes the whole game. It's just like Uber, right? So if you want to kind of operate a taxi in New York City, you have to pay $1 million to get that medallion to operate, right? But if you're on Uber, you don't have to. So obviously the cost is going to come down, right? That's what Uber provides. I don't know whether I was able to answer your question, but yeah.
Yeah. And another, I guess that's one of the final questions. Is there any loan processing fee that you're charging currently from the borrowers?
Yes, I said anywhere between 2% to 5%, depending on the risk of the borrower. Higher risk borrowers gets charged more because they make me work harder. Okay, so that's the reason he's charged more. And it is fair.
Arij, I guess that answers your question on the chat.
Vinay, I have a few questions regarding the system that you mentioned. That's a very interesting analytics-based system that you have. It was very interesting to see how you were saying that you can even track the defaults or delays that might come in the future. You can predict that with the system.
Yeah.
So what's the how much has it helped you in recovering as compared to like a traditional bank? Like how many?
So I can give you data.
Have you recovered that have not resulted in defaults?
So I'll tell you. I'll give you data. Okay. So we clock 0 to 30 days right now. Okay. This is post COVID, and before COVID it was 95%. Today this data is talking 97%. So 0 to 30 we clock 97%, which is better than Bajaj Finserv. We're the best in the country, and all of this is because of the data. So there is a lot of pre-warning that we get, okay, before a customer, well before the customer goes bad. And in this entire game, if you can move fast and you can lodge a legal case against the guy, okay. So basically, who's the guy who's going to take him to court first? Is the guy who's going to get the money. As simple as that. So you put all the pressure to kind of create that for him, and he'll kind of release the money. If somebody else files a case before you, so then he's going to pay him first before he can come to you. Even the court will not entertain you because he will say, "Uska chal raha hai, so let this happen," and then there's another hearing which is going to happen. So it's he himself, the borrower himself will say, there's already a hearing happening for me. I cannot give another date for. So that it becomes so if you moved first, chances are that you will get the money. So that's what the endeavor is for us. So data helps like that. That's one. Second is that, since we've been dealing with customers who have been not given loans, from banks and NBFCs, so traditionally we've been, looking at customers who are slightly more riskier, right? And that teaches me a lot. Okay. So today I have the understanding of data far, far more better than the banks, do, because they don't kind of trade to riskier borrowers, right? So to understand riskier borrowers, you need to understand bad. Bad teaches you. Good does not teach you anything, nothing. If you give 100 customers loans and none of them default, there is no learning, right? But if you give customers hundreds of customers loans and 5-10% of them default, you have learning now. Now you're kind of going to figure out why these customers defaulted. And if you look at data for the past 5-6 years, you see a pattern. Okay, and that pattern will tell you, hey, this is a customer that you should not lend to. This is a customer you should lend to. Okay, so let me just give you some maybe interesting data point, right? So one of the things that we did when we started our journey, I'm not from a financial services background, so a lot of people said women are better borrowers. Okay, and we believe that women are better borrowers. And we started seeing that early on our platform. Women who used to kind of take money from our platform used to kind of pay back on time. All of that, there was some method to their repayments. Okay, but as we scaled, we saw women and men both as equally delinquent. Okay, now I think that was the first time somebody actually called out that women and men are both equally delinquent. But we were not very happy with the entire thing, right? So we always wondered, how is this possible? Because women are more disciplined, they are more organized, they're more little, careful about money, all of that. So how can they be, more indisciplined in terms of, as compared to men? They are equally delinquent like men. Then we dug data deeper to realize, and that's what we plugged, some 6 months back. A lot of men used to take, so a lot of women used to take money for the men. Okay, now you cannot get this layered data till the time you see the data. It's easier to say. Now I can say with confidence, women are better than men in terms of loans, but backed with data, not hear and say. Okay. The other thing that we always talked about were people living in their own houses are better than people who are living in rented accommodations. Absolutely no correlation. No correlation. People living in their own houses are defaulting, and people living in rented houses are paying on time. So data talks completely different language. So it's important for us to kind of understand data from data rather than hear and say. And any investment, I'm not just limited to lending, any investment should be data driven. It should not be emotion driven. Okay. The moment you put emotion to it, you will go all wrong.
Got you. And in terms of numbers, like a general process of a loan would be first person would go into delay and then eventually he'll default, right?
That's right.
So how is what in terms of numbers, how many how better is your system as compared to a bank? Let's say 10 loans go into a delay, and out of that 5 get into a default for a normal bank. So in terms of your system, how better is that?
No, my system would have more default than the bank's system. Okay. But where is the default sitting? That's also important. How much am I charging for those defaults? If it is sitting on 36%, I'm charging 36% and there are 10% default there, I'm okay. Lenders are still making 26% or thereabouts, right? So the important thing is to, through data, able to figure out it's not about just because Ghaziabad, if you lent out to 100 people and 10 of them default, you stop lending to Ghaziabad. That's what banks do, right? I don't do that. I'm trying to understand why do these 100 people, out of these 100 people, 10 of them defaulted and not lent to those 10 in future, but to lend to kind of others who are paid on time. Is there a way to do this? Yes, there is a way to do it. Data tells me that to do it. So my data is not about, trying to kind of mitigate risk for me. It's risk pricing and, making returns for my lenders.
So Raghav, what Vinay is trying to say is his job is not to make sure that the market is risk-free. His job is to make sure that a person who has a particular risk appetite is being fed with the right product.
Yes.
His job is not to remove risk from the system. His job is to rate the risk in the system. And whoever is lending must be wise enough or must be intelligent enough to choose of what risk appetite suits what kind of return. Actually, so that's the model about it.
Yeah. So it's like this. So if you look at India, okay, a whole lot of people are not educated well. Okay. So I'm saying the formal education and also the further education, the masters or whatever that they do is they're not educated, right? So because they're not educated, they end up in jobs which are not very stable, okay? And because they are not working in stable organizations, they end up living in an area which is not very exciting. Okay, they'll be subject to a lot of infection, open nalis, all of that is there. Some of the family members will be in the hospital, once a quarter. So they will be, grappling with this health issue once in a while, right? Well, whether you like it or not like it, 80% of India is this. Do you think it makes sense to lend them? Yes, it makes sense. You think, can we bring them up? Yes, we can bring them up. You don't need to price them right and bring them up. And if you decide not to kind of lend to them, we'll always be like that. That's not the way. That's not at least the endeavor that we have set out for. Is there a way to kind of look at those customers? See, you have to look at it from on the other side. Okay, 10% are not paying you back. 90% are paying you, right? Hey, how about this 90%? Can we make money out of them? Of course you can make money out of them. That's the question. So my job is not to kind of arrest default. Default will happen as we climb the risk. My job is to make sure that in spite of the default, am I returning lenders money or not? Okay. So I'll give you an example. So there's a platform called Cabbage with a capital K, right? Cabbage out of US. They lend money to small micro SMEs, right? They operate the platform at 24%. 24% in the country like US. And lenders get a return of close to 10%. There is a default of 14%. More default than lenders get return. But to get return of 10% in US is crazy. It works. It's $1 billion company. So they're not trying to kind of, see the way banks are seeing, just to kind of make sure 850 ke upar walon ko hi loan dena hai, a lakh of rupees salary only, then you'll get a loan. So those things, those things they don't look at. They look at purely on databases, whether this has a potential to kind of, get money back or not. If they don't have, then they don't lend. If they have, it goes through.
So the social part of it is we are open to lending everyone. It's just that we will rate them at a higher risk, irrespective of, and I'm sure 90% would pay back.
And that is the only reason RBI has regulated us. RBI has regulated. If it had done exactly the way the banks have been doing it, we wouldn't have. No. So I don't want to become a bank.
We're basically giving more penetration in terms of lending.
We do a lot of microfinance loans, by the way. Okay, so we have tied up with some 4 microfinance companies. We lend out loans to rural areas with data, with back data of the organizations. Things they don't have money, right? So they have a problem with money. They have a limitation on regulation with respect to the amount of money that you can give to a person through microfinance. But these people need more money, and this particular company tells me that this customer has been with them for many years. Has taken loans so many times. All of that is there. This is that we extend them personal loans. 30,000 rupees, 50,000 rupees personal loans, we extend them. Great partnership.
Vinay RS has another question here for us. I'm sorry, I'm interrupting, just rushing through the question. The question is, do we settle with non-performers? Also, if we settle with non-performers as a company, how does that affect a lender?
So we have very tight policy on settlement. And that policy is there, published on the the website. And if, in spite of that, if the lender is or the borrower is wanting to settle, then he could settle and pay off the loan. It has a gestation period and all. Uske baad bhi then basically the idea is that we try everything before we get to settlement. So all of that, legal, shegal, and all of that we do. Only then we kind of agree. It's not that the guy will come up and say settle kar lo, nahi hai, aisa nahi.
Okay, and also because we are very transparent, so the lender will be aware of every step of the settlement process. Also, if we go to
all of that will be there.
Okay, Aritz, I hope that answers your question.
One more question is that This FairCent is a...
yeah, Rajesh sir, please go ahead.
This FairCent is a registered NBFC company with RBI, sir?
Yes. So let me just give you some background about FairCent. We've been operating for the last 6 years. The slides didn't have that.
I'm also registered on FairCent portal as a lender.
Okay.
Rightly, I am not actively participate, but I'm already registered.
Okay, all right. So we are a 7-year-old company. We've been operating for the last 7 years, and we started when the fintech word was not coined, and we saw this opportunity. We have people, both me and Rajat are from marketplace, two-sided marketplace. We've built a lot of organizations like Times Jobs, Magic Break, Simply Mary, and all that with the Times Group. I was earlier with Rediff, Sifi, all of that. So we understand marketplaces. I used to do operations of e-commerce in Sifi. Before that, I was with Rediff. So we understand, two-sided marketplace better. And we look at this business like that only. Lending business. If there is a demand side, supply side, we try to kind of cater to that and make sure that it makes sense for both sides, right? And we've been in the last 6 years of our journey, we've been, we've raised some money also through some of marquee investors. From India, we have raised money, through GM Financial, Muthoot Group. There's a Mohandas Fund Capital, RN Capital, and 314. Then a bunch of Japanese guys invested in us. The fund out of US is invested in us. And there is a large fund out of Belgium who's invested in. Last round was led by them. It's a company called Incofin, which is a Belgium-based fund. They've invested in a lot of NBFCs in this country. They only, invest in companies which has some kind of an impact, to the society, reaching out to a larger section of the population who are not touched by banks and NBFCs, large NBFCs. Yeah. So we have also won a lot of awards, a lot of applause across the world. Our technology has been, raved globally. We were NASCOM incubated, then Microsoft accelerated, and we have one case study which was done by IIM Bangalore, which is published in Harvard Business Review. It's a case study where you have to pay to kind of get that case study. It's not a free access case study. So so we've published a book on P2P lending, which is on Amazon and Flipkart. We have a very extensive YouTube channel which talks a whole lot about lender education. And we have some bunch of very smart guys. Our analytical head is 10 years with Citibank, doing analytics, and with Bank Bazaar, companies like Clicks Capital and all before he kind of joined us. So we have some really good pedigree people, good exciting rule engine that we have, which people have built. We also are having an institutional side also. Okay? This is the retail side. We also are building out an institutional side, which is not under this particular peer-to-peer license. It is a digital play right now. So we hope that a license will come out in that space as well. So there we are onboarding institutional lenders, NBFCs, family offices, LLPs, money lenders if they have license. So they can come and lend on those platforms. And there is no limit there. In this peer-to-peer, there is a 50 lakh limit. And we're doing exactly the same thing there also. So we have this onboarding stack, the curation stack, the collection stack, or the entire money movement stack, collection stack, and the legal recovery stack. So these are various stacks that we have. So we kind of put this out to the NBFCs, and whichever way they want to kind of navigate with that, they can. So two sides. So all transparency. So nobody has this kind of transparency across the country. So the problem with the institutional side is that people don't know where the money is going, right? So you're shown in your bank account, net banking, that the money is there, but you don't know whether it's there or not. Yes Bank is a classic example, right? We will not to kind of take our money back. So the institutional side, it's a little, there's a lot of governance issue. The people are, it's not transparent. So the belief system is kind of slowly kind of going away. That's the reason people are more invested in people rather than organizations nowadays, globally. It's a global phenomenon. Kids today are a whole lot, we are still kind of in the traditional way of looking at things, but the generation which is coming up, they're all invested in people more than organizations per se. So so that's how That's how we work. And that's the kind of background that we come from.
And Vinay, could you share what the impact of COVID has been? Like, has the percentage of return gone down, or has it like maybe gone down into negative, or is it, or has the like impact yet to come?
No, so we have gone through COVID pretty well. Our collection kind of brought down to 60%, 62% in fact, to be precise, in the month of April. And then we navigated, picked it up back. I think September onwards, we were 95% back, the first bucket. So the leaking part got, corrected or got fixed within, 2 3 months, 3 4 months. And post that, we were trying to kind of figure out the ones which got impacted to kind of pick up. Now we have at least 3, we gave moratorium to some of them. We have very hard conditions on moratorium. We gave, so that 3-4% of the population is still have to come back to kind of give the money back. Our impact has been very less. And the reason for that is that we are completely digital and we don't kind of go out and collect money. So all of that is not there. So from that point of view, our business grew in the last 6 months, 6-8 months when the COVID happened, because banks and NBFCs stopped lending, right? So a whole lot of these customers start coming to us. So we saw huge unprecedented demand coming to our to us our way, and that saw a lot of lenders come and participate as well. Yeah.
In terms of numbers, like do you expect the 12% ROI to drop down to?
No, from here on, no, I don't think so. I don't think so. I'll tell you why. Because currently, so we got down to around, so platform historically has returned now 15 to 16% return, historically, okay? But our credit models have evolved over the last, few years. And as of now, if you look at it, we just leave the COVID part. We kind of COVID dropped down a couple of percentage, but otherwise, we look at it, right now, the platform is returning anywhere between 17 to 18%. Now, within that, we're talking about all kinds of borrowers. So here we are saying that we will pick up only, stable borrowers, good borrowers, borrowers who have, decent record, on the bureau. The default percentage is very, very low. All of that, So the ratios of default is going to be low. So we are going to average around, 50-odd%, and ensure that we lenders get, maybe a 1-1.5%. Even if there is a 1-1.5% default, lenders will still make 12%. So we don't see, at this point in time, we don't see, because we come out of COVID and we have stalled everything which is related to COVID. And that's an exercise we periodically do every time. 3 years back, there was a slowdown in real estate. We stopped real estate onboarding. Last year, a couple of years back, the NBFC slowed down. We stopped onboarding NBFC customers. This year we had COVID, so all the hospitality, hotel, restaurant, airline, all of these were stopped. And we look at this not just by industry, but also the lag effect to that particular industry. So anything related, for example, call center out of this thing will also get impacted. Let's say airline company. So all of that we look at. Allied, all the services we look at before we stall something. So all of those customers are stalled to kind of get onto the platform, because we see that the chances of them losing a job in the future also might happen. Or for that matter, they might get another job, and now they are sitting pretty thinking that they're okay, but the impact of that will come later. Those guys also might lose their job. So all of that is, so for example, banking financials, we're not looking at, because we see a lot of it will open up next quarter. We are wary of banking financials right now. We're not onboarding customers who are from banking financials. So you'll see moratorium data is going to come out, and we'll see a lot of numbers getting crunched, a lot of jobs being thrown out.
Of course.
My sense is, yeah.
Of course. And you had mentioned you keep geographical constraint also, like you don't want exposure to a specific area. So do you have a limit for that? Like you won't expose yourself more than 10% to, let's say, Bangalore or something?
Yeah. That's, I talked about it initially. So we have spread to 600 locations. And our biggest market is Bangalore. Bangalore occupies 3% of the total share. You can imagine the kind of spread we have.
Okay.
Great. Vinay, time's running. We have I have another session on the same idea.
Thank you, guys.
Thank you so much, everyone. And thank you so much, Vinay. I guess that was way more time than we had expected. Thank you so much for a beautiful insight. And for all the members at Together Investing Club, we will be we are partners with Faircent now, so you guys can directly connect with us, and you guys can directly connect with Ravi and Vinay as well through us whenever you're in that jest. Also, we'll be conducting another session from Ravi, who represents Faircent, where we'll be talking about the portal, how the portal works, and how we can actually become lenders on the portal, or how we can actually do the lending part or start getting investors from that part. Thank you so much for your time, Vinay. Looking forward to more interactions.
Thank you.
Thanks,
Thank you.
Emmanuel. It's been a really informative session.
Thank you so much.
Thank you.
Thank you.
Thank you, sir.
Yeah, guys, enjoy of what left is left of the Sunday.
Yeah.
Take care.
Thank you.
Bye.